What does a new Fed enforcement action mean for your portfolio? And why should a case involving a former bank employee matter to everyday investors? The Federal Reserve just announced an action tied to a former employee of First Financial Bank. It is not about interest rates or inflation. It is about conduct, controls, and accountability. That distinction matters because supervisory moves shape how banks manage risk, safeguard customers, and sustain earnings quality. Here is the context. The Fed is a supervisor for many banks and holding companies. When it sees violations or unsafe practices, it can act against individuals as well as institutions. In this case, the focus is on a former employee, which usually signals limited impact on the bank's daily operations. But it still sends a clear signal. Governance and personal responsibility remain in the spotlight. So what typically happens in these situations? The Fed has a toolkit designed to protect the system and its customers. It can require fixes through consent or cease-and-desist orders. It can prohibit someone from working in banking if conduct crosses serious lines. It can assess civil money penalties, and it can require restitution when customers or the bank suffered harm. These steps rest on established laws and supervisory guidance, and they can apply to directors, executives, and staff, not just the institution as a whole. Why does this matter for investors and risk managers? First, it clarifies supervisory expectations around documentation, oversight, and fiduciary duty. That shapes how banks design training, controls, and escalation paths. Second, strong governance can lower the cost of capital and support steadier earnings. Markets tend to reward institutions that demonstrate consistent compliance. Third, enforcement headlines remind lenders and analysts to look closely at loan quality, loss reserves, and audit findings, because conduct and credit discipline often move together over time. For First Financial Bank specifically, the announcement points to a former employee, not a change to core operations. Even so, prudent banks often use these moments to refresh policies and tighten monitoring. Customers rarely see disruption, but behind the scenes, risk committees and compliance teams take note. Your practical takeaway: monitor the bank's disclosures, including regulatory orders and any references in earnings calls. Watch for commentary on internal controls, training, and remediation. Compare trends in net charge-offs, non-performers, and capital buffers to ensure the institution's risk profile stays sound. If you are a long-term investor, favor banks that demonstrate a culture of accountability, not just strong quarterly numbers. Want the details and links to the source notice? Read the full article at finlitica.com.